The balance sheet is one of the three main financial statements. It provides a snapshot of the company's financial position at a specific point in time. It's a crucial document to be able to understand a company's financial health, stability, and performance. Very simply, a balance sheet outlines what a company owns, what it owes, and what's left over for the owners. So in other words, if you were to shut down the business today, what would you be left over with? The balance sheet is one of the three main financial statements, the other two being the cash flow statement and the income statement. And if you'd like to learn a little bit about those, you can check out the videos in the description or in the corners. And while the balance sheet is quite important, how important it is can vary quite a bit with the industry. For example, say a real estate company that has a lot of assets and a lot of liabilities, the balance sheet's super important. But if you run a business that's kind of asset light, like a marketing agency, then really all that matters is your cash and your accounts receivable. So while the importance can vary compared to the other two financial statements, it is still very crucial, so let's dive into it in this video. The balance sheet is based on the fundamental accounting equation. Assets is equal to liabilities plus shareholders' equity. If you're not familiar with the accounting equation, you can check out our video about the accounting basics in the corner of the description below. Real quick though, assets are anything of value that a company owns or has control over. So for example, that can include things like cash, inventory, machinery, land, or even investments in other companies. Liabilities represent a company's debt or obligation to third parties. So that'll be stuff like accounts payable, customer deposits, or loans. And equity is what's left over for the owners of the company once you deduct all your liabilities from your assets. So basically, if you sold off all your assets and paid off all your liabilities, what would the owners have left over? So let's go into a little bit more depth on each of these. The assets on your balance sheet are usually going to appear split into two main categories, current and non-current. Current assets are those that are expected to be converted into cash or used up within 1 year. They're highly liquid, and these are the short-term resources that a company uses on a day-to-day basis to conduct operations. These are usually ordered on the balance sheet in order of liquidity. So in other words, how quickly can it turn into cash? So cash, which is already cash, will usually be at the top. After that, you'll find accounts receivable, which usually converts to cash within 30 days, and inventory, which can take a little bit longer, will usually be below that. Some other examples of current assets are things like prepaid expenses. So for example, if you pay for 12 months of insurance in one lump sum, that entire amount will be consumed within 12 months. Another example is short-term investments like marketable securities or treasury bills. Non-current assets are those that you'll usually be holding onto for longer than a year. One of the most common examples is property, plant, and equipment. So that's stuff like land, buildings, machinery, or vehicles. Another example would be a long-term investment, like if you were to purchase a minority stake in another company. And you also have intangible assets, which are things that don't have physical substance but still have value. For example, a very valuable patent or a copyright. Understanding the split between current and non-current is important because it helps you understand how much flexibility a company has to be able to get cash in its hands really quickly. Next up, we've got your liabilities. Now, these are defined as a present obligation arising from past events that will require an outflow of economic resources to settle. So in other words, what obligations do you have today that'll eventually need to be paid off? So liabilities, like your assets, can be split into your current liabilities and your non-current liabilities. So your current liabilities, like your current assets, are those that are expected to be settled within 12 months. So some examples are your credit card balances, which you have to pay off every month. You have your accounts payable, which are amounts that you owe to your suppliers or vendors for goods or services that are usually paid within 30 to 90 days. You have accrued expenses. So for example, if an employee earned a bonus but you haven't paid it yet, that would be a current liability. You have customer deposits, which are money that you've received from customers that you still have to do something to earn. And then you can also have your current portion of long-term debt, which is the portion of the debt that needs to be paid within the next 12 months. Your non-current liabilities are those that you're going to settle in more than 12 months. The most classic example is your long-term debt, but this is just the bulk of it that's not due within the next 12 months. You've also got pension obligations, so basically what you're going to owe to some of the employees when they retire. And then you also have deferred tax liabilities, which is a future tax burden you're going to have because of the difference between financial accounting and tax accounting. This is actually super complicated, so we'll just leave it at that. Understanding the split between current and non-current is important because it gives you a sense of how much urgency there is about meeting your obligations. And while liabilities are often debt, it's not always a negative thing. In many cases, you need that debt to be able to fund growth, so it can be a strategically smart move. So evaluating your liabilities effectively will usually be done by looking at your assets as well. The last section is your shareholders' equity. This is what's left over when you deduct your liabilities from your assets, and it represents the value that the owners of the company have. This can kind of give you a sense of the overall value of a company, but in reality, it's a lot more complicated than that. There are a few different categories that you'll find in this section, but the two main ones are going to be your common stock and your retained earnings. Common stock represents the value that was contributed by shareholders in exchange for ownership in the company. Retained earnings represents all the accumulated profits that the company has earned since inception that it hasn't yet paid out to its shareholders. So for example, if a company was earning $1 million per year for 3 years, its retained earnings would be $3 million. If it then paid a $500,000 dividend to the shareholders, then the retained earnings would be $2.5 million. There are a few other sections that'll appear in your shareholders' equity, but those can be a little bit more advanced, so we won't touch on them here. Okay, so now that we know how to read a balance sheet, there's a number of methods that you can use to analyze that data and better understand a company's financial health. One method is that of trend analysis. This involves comparing balance sheets from multiple periods to identify changes in key components over time. For example, if you see an increase over time in property, plant, and equipment, that's an indication that they're investing in the ability to have greater amounts of output. If you see a decrease over time in accounts receivable, that could be because they're getting better at collecting the receivables, but it could also mean that they're not selling as much as they used to. If you see an increase in accounts payable, that could be because they're having trouble paying their vendors, or it could mean that they've done a good job of negotiating better terms with those vendors. Trend analysis basically won't often give you the answers, but it'll help you identify the right questions to ask. Another very important approach to analyzing the balance sheet is that of ratio analysis. This involves calculating and analyzing the ratios between different components of the balance sheet. For example, the current ratio measures a company's ability to pay off its current liabilities, those that are due within the next 12 months. This is calculated by dividing your current assets by your current liabilities. The higher the ratio, the better the company's liquidity. What it's basically saying is that your current assets, your cash, your inventory, your accounts receivable, can cover your short-term obligations that are coming up. The quick ratio is similar, but it excludes some of the less liquid current assets like inventory. So for example, if your cash and accounts receivable is enough to cover all your current liabilities, then you're in pretty healthy shape. The debt to equity ratio is calculated by dividing your total debt by your shareholders' equity. This gives you an idea of how much of the company's assets are due to debt versus the company's own value. And some of the ratios will include components from outside the balance sheet, like your inventory turnover. That's calculated by dividing your cost of goods sold by your average inventory balance. And it gives you a sense of how much inventory you're holding relative to how much you're selling. You generally don't want this ratio to be too low because it implies that you're selling very little inventory but holding way more than you need. While the balance sheet is very powerful, it does have some limitations. And it's important to be aware of these so you know how to analyze the data more effectively. Number one, it's just a historical snapshot. It represents a company's financial position at a specific point in time. But it doesn't necessarily tell you how things are going. Two companies can have a very similar balance sheet, but one can be growing while the other one is on the decline. Another limitation comes from intangible assets. These are things like patents, trademarks, or intellectual property. One of the biggest intangible assets can be that of a brand name. Just because of the way the accounting rules work, these will usually not appear on a balance sheet. So even though a company with a hugely popular brand name might not have that asset appear on the balance sheet, another company might still be willing to pay a lot to acquire it. A third limitation is that a lot of the items on a balance sheet will oftentimes be the result of certain estimates or judgment. For example, if you bought a building 10 years ago for $20 million, you might be depreciating that at $1 million per year, but that might not reflect accurately how much the building is worth today. Or for example, you bought inventory for $2 million 3 years ago and for some reason you haven't sold it. You might have to sell that inventory below cost to be able to get rid of it, which means you should be writing down the value of that inventory on the balance sheet, but that also is just an estimate that requires judgment. So a lot of the items on the balance sheet might not be a perfect representation of its actual value. There are also some things that just don't appear on the balance sheet yet. For example, one of your products severely injured somebody, so a lawsuit is coming and you're gonna have to pay. So even though there is going to be an obligation, depending on the state of things, that may not appear on your balance sheet at all, or may appear as a very inaccurate liability. But overall, while the balance sheet does have some limitations, as long as you're aware of this, it's a very powerful tool to be able to evaluate a company's financial health. So thank you for watching this introductory video about the balance sheet. If you enjoyed listening to me, please click the like and share and subscribe buttons. But for now, take care.